Evening, good evening. Thank you guys for logging in tonight. I am super excited for this presentation. So, before we get started, could you guys put what city that you guys are logging in from tonight in the chat, please? Please go ahead and put the city that you're logging in from tonight. That'd be great. Okay, so I'm logging in from Toronto. Anybody else? Okay, we got Waterloo. Awesome. Toronto as well. What is this? Melaton, Fergus, Hagersville, Bowmanville, Ottawa, Oshawa. Wow. This is great. Mississauga, this is great. Awesome. Thank you guys so much. So, how long have you guys been a landlord? If you guys can put in the chat how long you've been a landlord for. I've been a landlord myself for about 16 years. Can you guys tell me how long you've been a landlord? 5 years. Okay. 2 years. Awesome. Almost 3. That is fantastic. Great. We got some nevers and no years. Awesome. This is great. So how many properties do you guys have? So myself, I have 8 properties. Would love to know how many you guys have. Got 2, we got 1. Okay. Anybody else? 1 property in Canada, 2 overseas. 1. Awesome. Thank you guys so much. Thank you. I just wanted to know who I'm speaking with tonight. I also wanted to thank you guys for carving out time to be with me tonight. And I promise that it's going to be worth it. My name is Charles Ayodele. And I've been in the industry now for about 14 years. I have several properties myself. This particular presentation tonight is going to help Canadian homeowners make more money. In this time where we're seeing high interest rates, did you guys realize that the average Canadian family is spending about 43% of its income on taxes in 2021, according to an article in the Globe and Mail that came out last year? Landlords are finding things a little bit more tight these days, and their rental properties are just not cash flowing. You're finding situations happening where landlords are taking risks and putting 25 people in a basement to rent. That actually happened earlier this year in January. The strategy we're going to be talking about will alleviate some of that. The number one problem in today's generation and economy is the lack of financial literacy. So a few housekeeping rules before we get started. If you guys have any questions, please put them in the Q&A section. We will use the chat to interact with tonight. So a quick disclaimer, this information is for informational use only. I am not an accountant and I'm not a financial planner, but tonight we have Jacqueline, who is a financial planner, who's going to be with us talking a little bit from a financial standpoint. Please, Jacqueline, introduce yourself.
Thanks, Charles. As Charles alluded to, I am a financial advisor. I am located, I work out in Mississauga, but I service individuals all across Canada. I've been doing this for about 10 years, and I help working professionals and landlords really make the most of their investments and grow their wealth, like Charles said. So happy to be here. Thanks for having me, Charles.
Thank you. I think the storm over the weekend hit Mississauga the worst. Am I correct there?
Yeah, it was pretty crazy. I'm down in Port Credit, so I didn't see a lot of it, but just north of me, I mean, it was like a river flowing across Dundas there, I think. So
Yeah, there
I'm
was
glad I
one
was at
sign that
home.
I saw that said "Welcome to Mississauga," and there was a big. I was just like, "Wow, that's
I
crazy."
can't believe that happened. That was wild. wild.
Awesome, awesome, awesome. Okay,
Yeah.
so this presentation is going to be roughly about 45 minutes long. So before we get started, I have a question that I want to ask everybody. Hold on one second. Before I start, I forgot to click in my presentation. Let me just share my screen here. Give me a second. One second here. Okay, what's going on here? Oh, awesome. Okay, so I had one question to ask. Would you guys rather have an 850 credit score, $4,000 a week for life, or $2 million up front? If you guys can put in the chat which one you guys would rather have, that'd be great. 850 credit score, $4,000 a week for life, or $2 million up front. $2 million up front. Anybody else? $4,000 a week. $4,000 a week, 850 credit score, $4,000 a week. Okay, 850 credit score. That's great. Thank you guys so much. Usually the popular answer is $4,000 a week. Okay, so with the 850 credit score, that is not the right answer. That will get you maybe about $50,000 line of credit. That's probably the best you'll be able to get. The actual right answer is the $2 million up front. You would take that $2 million and you can invest it into an investment vehicle that can get you a rate of return anywhere between 20 to 30%. And when you get that 20 to 30%, you can now get the $4,000 a week. That's just over $200,000 a year, right? And so you actually can get both of them simply by getting the $2 million up front. So the question a lot of people ask me when we go through this is, what investment vehicle is going to give me a rate of return of 20 to 30%? Well, most of you actually have it already. It's in your home. And that's what we're going to be talking about here tonight. So if you guys are listening to this, you're most likely a homeowner, or you're in the process of becoming one. You've committed to making payments on your mortgage for the next 20 to 30 years or more. And you also have at least one rental property, or you're considering on acquiring a rental property in the near future. What we're going to show you is how to structure your mortgage in a way that helps you be more tax efficient so that you can grow your real estate portfolio and keep more money in more of your hard-earned money along the way. Then we're going to show you how to get those savings, your tax refunds, to reduce your mortgage balance, pay less interest, and become mortgage free ahead of schedule. By paying off your mortgage sooner, you free up expensive mortgage payments that hold you back, which gives you more room for other more important things, such as improving your lifestyle, buying more real estate, or getting a jump on retirement. And it's achieve these benefits without contributing any extra cash beyond your regular mortgage payment on your home. I know this is unheard of because most financial strategies typically need you to add money in order to earn the benefit. When I first started in the business of doing mortgages, I had a client who came to me from a real estate intensive program, and she was pumped, ready to go. We pre-approved her, she's ready to buy. She had one problem. She didn't have the down payment to purchase the property at that particular time. Because she used the money for the real estate intensive, that got her pumped to actually come and see me and actually wanting to buy. So she actually had to wait to save up that money to be able to purchase later on down the line. Well, with this strategy, it doesn't require you to do that. You simply are reorganizing your cash flows and payments that you already have in a way that makes you more tax efficient. And the benefits come in the form of tax refunds and the interest savings when you get those refunds to pay off your mortgage faster. Your money is going to servicing debt. Homes are expensive. People are borrowing more. Rates are higher, and the affordability is worse today than it's been since the early 1990s. It's difficult to make ends meet and maintain the lifestyle we've grown accustomed to because incomes aren't keeping pace. The rate of exhilaration in the cost of living far exceeds our capacity to absorb those increases. Some people have the earning potential to beat inflation, but those are just the lucky few. Anyone that's on a fixed income is feeling the shift that is happening right now in the world. This is important to acknowledge because it's not getting any better. People are starting to make concessions. Unfortunately, the thing that often gets sacrificed first is the money we put aside for future savings. The practical reality is, if someone is having a tough time affording today, how are they going to put enough money aside to also afford tomorrow? So, how many of us are just working to manage what's in front of us right now in this particular moment, let alone have a plan to deal with inflation, to beat higher interest rates, offset growing taxes, and save enough to also carry us through our after working years are behind us? People are starting to adjust expectations around when they are able to retire, and their lifestyles are also changing because of their golden years. Longer, even before, ever before, we're already not saving enough to adequately support those extra years. Couple that with the rising cost of living, and it's easy to see why we need solutions like this to regain our financial edge. Because these pressures aren't going away, inflation isn't going to magically stop anytime soon. Even when the government manages to get us back to a 2% target, it's still an issue. Think about it. If we look at our home prices, our cars, groceries, fuel, clothing, and even travel, all of these things over the last 15 years, right? We know that the values have gone up. So if inflation, quote unquote, gets to a controllable rate, do you think those prices are going to go back to where it was 15 years ago? No. But guess what? 15 years from now, they're going to double. But for the most part, we haven't seen incomes keep pace. People aren't making twice as what they made 15 years ago, which means that we're losing ground and it's getting worse. A quick story for you guys. I graduated from the University of Windsor in 2003. And one thing me and my friends all wanted to do was make our degree work, right? So we got out of school and the goal was get a $40,000 job. That $40,000 job was going to be able to get us out of our parents' home, buy our own place, get our clothes, and you have fun, you meet somebody, and then you guys combine income 40, and you're able to now buy a bigger home. This is in 2003. How do you think that stems to today? We know we're seeing articles out there where people are making over $100,000 alone and they're struggling to make ends meet. That's what's happening. We aren't suddenly going to find ourselves with more money. We're not miraculously going to be able to save more than we already have been. And we know historically, the little amount we do save isn't enough. We know this because we have an aging population that's having a difficult time making ends meet. All right, check this out, guys. Here's a true cost of a mortgage. When you look at this over the entire life of the mortgage, it's significant and it is heart-wrenching. Most people already know that the true cost of a mortgage almost doubles because of the interest paid over time, because very few people ever take into account how much earned income it takes to pay it off. Let me show you guys some math here. So the mortgage starts at $500,000, interest rate of 4.5. You're paying a monthly payment just over $2,500. Your total payments over 30 years is $912,033. Your total interest is $412,033. If you're at a pre-tax income of 40% marginal tax, you would have to have earned just over $1.5 million. Yes, that's correct. $1.5 million of earned income just to pay off a $500,000 mortgage. Wouldn't it be nice if we had a way to get some of those tax dollars back and put them to use by paying off our mortgages sooner, reduce our interest costs, and use the tax savings to put a little money aside for the future? The first roadblock for many Canadians is that we can't pay cash for our homes. We don't have the resources. We need the borrowed funds just to buy the homes in the first place. And because the government doesn't view our principal residence as an investment, because our home doesn't typically generate income, we cannot write off the interest. The issue remains that we're not using the debts to finance our personal lives, and we're servicing the interest with after-tax dollars. Basically, the complete opposite of how wealthy Canadians manage their finances. When a wealthy person buys a home, they try to put as much cash down on the home as possible because they don't want to carry any debt unless it's tax deductible. They know that when they buy a home to live in, you can write the interest off. So any mortgage they get to purchase is considered bad debt because it can only be paid off with after-tax dollars. It's not that the wealthy person doesn't carry debt. They probably have a lot of it. It's just that they prefer that it be tax efficient, so they're able to pay less towards a mortgage over time. The rest of us are doing it backwards. We take on as much debt as possible to buy the home, and then we use it to cash invest into, and that's what we're doing. We're using our cash to invest. Quick story. I actually have a friend of mine. She runs a business online, and she made a lot of money during COVID. And she was asking me what should she do? I said, well, the smartest play is mortgage. Pay off your mortgage on your home. where you live, and then get a line of credit, right? And then use that line of credit to now invest back in your business. So anything that comes out of you paying for your home now is now tax deductible, right? And she's able to save on taxes by doing that, right? Now, she has the opportunity to do that because she actually had the money, which most rich people do. But what can we do for people who don't have the big lump sums to do that? And that's what we're going to talk about next. The first being that they don't sit on debt equity. They seek out ways to leverage equity and put it to work because it allows them to multiply the number of assets that they have, which turns the results of their wealth to a faster appreciation. Second, they get a tax benefits because they borrowed the money to actively contribute / invest in the growth of the economy, of the expansion of wealth. When you borrow to invest, as long as the investment has the capability of generating income, then the government lets you write off the interest of the borrowed debt. It actually doesn't matter what investment it is. Think about this. Simply by having a rental property, that's considered an investment. The third thing, the debt doesn't have to appreciate. In fact, it can lose value over time. And the fourth and most important benefit, while the debt stays static, the assets of that income that is generated tends to appreciate with inflation. This gives them the option to leverage the asset and the income in the future, which helps them retire the debt or can be used to improve the lifestyle or buy even more assets. So this is what the rich person does. First, they take the personal cash, they buy a home to avoid carrying the bad debt, right, which is non-deductible mortgage. This is illustrated in the blue area on the left side here. Then immediately after buying the home, then they borrow the funds back out to invest to build wealth, which is the yellow, which is the good debt. So, provided that the investment you choose generates income, you can use the income plus the tax savings to exhilarate the plan. So check this out. So this is what, if you don't have the lump sums, this is what you would do. Over time, these benefits are compounded as you transfer more money from one side of the balance sheet to the other, with the ultimate goal of converting your non-deductible debt as fast as possible and convert it into tax-deductible investments so you're eligible for the tax refunds against the debt. So simply what you're doing is every payment that you make every single month, you're bringing down your bad debt. And because you're making that payment every single month, you're opening up good debt on the other side with your investment line of credit. Explain what I mean. So if you guys right now, if there's one slide I want you guys to take in tonight, it's this slide. I want you guys to understand how the actual strategy works. This is how the cash stemming strategy works. So let me show you now. So you have your principal residence, right? And you're making the mortgage payment as usual, like you always do. And then you have your rental property. So people get the rental income as usual, and they take it and they pay their rental expenses. That's what everyone does. I do the same thing for my rental properties. But there's a missed opportunity. Did you guys realize that when you get your rental income, you don't actually have to use it to pay your rental property first? Logically, it makes sense to do that, but legally, you don't actually have to use it for that. You can use the money for whatever you want. So how about you take that money and you prepay your primary residence? You get a product, which is a readvanceable product on your primary residence, which is a mortgage with a line of credit on the back end. So when you prepay your mortgage with your regular payment, that prepayment becomes active right away and you'd be able to pull it back out. Then you use the money to pay your rental expenses. So here's a quick case study. In this scenario, the homeowner has $500,000 $500,000 mortgage on their principal residence. They use the mortgage to buy the home. So they're not currently, they don't have any tax benefit on this debt. This is what it is. So check out this particular scenario. We got the principal resident in the center, and we're making the regular payments of $2,804 monthly. The payment comes from the homeowner from the regular household bank account, same as they do today. Nothing has changed. That doesn't actually change. So up above, they have the rental property, right? And the income on the left and the expenses on the right. We receive over $33,000 in rental income annually on this property, which is $2,753 each month, that we can now use to prepay the mortgage and drive the non-deductible debt to the ground. That equity becomes available in the investment line of credit. And then we draw that same $2,753 back out into the rental checking account. From there, we use the funds to make all the payments in the rental property. That's the cycle. Every single month, we get our rental income and run it through our primary resident mortgage and convert the bad debt over into tax deductible debt. And watch our balance sheets change and draw the funds and pay off our rental expenses. So what do you guys think there, right? This is what I wanted to make sure you guys understand and know when it comes to the cash stemming. All right, I'm going to get Jacqueline to take over from here.
Perfect.
Like me to stop sharing, or you just want me to help? And what would you like, Jacqueline?
Are you able to provide me with sharing abilities? If not, I'll just have you flick through, okay? Okay. So thanks, Charles, for that. I really love the diagram that you put together. I think it makes it really clear as to how this strategy is working. And so what I wanted to talk about tonight is, you mentioned that this strategy works well. We're borrowing money in some capacity for the purpose of investment. And in the examples that you gave, you were investing in the real estate. So you were investing back into the real estate. This same strategy and this same concept works for investing into real estate, using borrowed money to invest it back into your real estate. Or you can also use it, the borrowed money, to invest in liquid investments. And when I say liquid investments, I'm referring mostly to investments into the stock market, what we would consider, buying, stocks and bonds, that sort of thing. So in other words, there is tax advantages to borrowing money and investing, whether that investing is into real estate or into liquid investments like the stock market, like I'm going to talk about tonight. So over the next 10 minutes or so, I'm going to talk about how you can sort of use this strategy for investing into the stock market. We're going to talk specifically about how you do it. And you're going to notice that there's some comparisons to investing in the stock market and what Charles showed on the screen just now. We're going to talk about, what's important to consider if you think this might be a strategy that you're interested in. And then, of course, we're going to go over a few sample ideas and a few types of investment portfolios that you could consider for this, okay? Again, the whole idea here, guys, is that we are using borrowed funds as a means to help build our wealth, okay? And one of the ways we can build our wealth is, of course, through real estate, but also through investing in stock portfolios, which is what I'm talking about tonight. And then, of course, I want to go over, why this is a good strategy, who it works for, but also who it might not work for, and just make sure that you're aware of some of the risks. Charles, can you click on to the next screen? Okay, perfect. So like I said, how does this strategy actually work, or what are the mechanics or the basics to actually doing this? So similar to what Charles just mentioned, is that if we're looking to borrow money for the purpose of investing, we first have to be able to borrow the money. So this might mean that we have something like a HELOC or something like the investment line of credit that Charles showed earlier. So Number one, we're going to want to set up a HELOC or sort of some sort of loan vehicle, and we're going to want to use it specifically for the purpose of then reinvesting. Okay. If you have something like a HELOC already, and maybe you've borrowed some money against it and you've used it to pay for things like, I don't know, a vacation or some personal expenses, we're going to maybe want to set up another loan vehicle. Charles can help you with that because whatever money we're borrowing for the purpose of investment, we want it to be really clear exactly how much money we've borrowed, when we borrowed the money, and what the interest rate is on that loan. If we're going to borrow the money and then reinvest, we just want to make sure it's very clean and we know exactly how much we've borrowed because that's going to play a big role in terms of the tax savings. Okay. Once you've figured out how you're going to borrow this money, the second step is you're going to open up a non-registered brokerage account. So what I mean by that is something like a direct trading platform, maybe at your bank, maybe a robo-advisor or a full-service brokerage firm like the one I work at, but you're going to want to open up a non-registered brokerage account. If you are planning to borrow money and then invest it into the stock market, any reputable Canadian brokerage house is going to ask you some questions and really just do their own due diligence as well to make sure that this is a strategy that works for you. As I mentioned previously, there is some risks involved with this strategy. So if you are thinking about doing it, I recommend you contact Charles. He's going to walk you through it. He's going to go through some due diligence. Wherever you set up your non-registered brokerage account is also going to go through some due diligence. Again, this is for your safety and just making sure that you're going to be able to service the loan that you're taking out for this purpose. The third step, and the most important step, is you then have to invest the money that you've borrowed. Okay, so if you get through steps number 1 and 2, and then you don't invest the money, you really haven't done this strategy properly. You haven't done yourself any favors. So again, we're borrowing money, we're opening up a non-registered brokerage account, and then we're investing that money. Okay, Charles, you can click through now. So before I jump into specific ideas and types of portfolios you might want to consider for this, there's a few things I want you to keep in mind. And as we go through this, we're going to identify who this strategy is going to work best for. So do you have the risk capacity and tolerance for this strategy? This is a type of strategy. There are some risks involved. We want to make sure that you both have the capacity and the tolerance for it. Capacity is if you've borrowed money, you're going to have to pay interest on that loan, on that borrowed money. Do you have the capacity to actually make those interest payments? Okay, that's important. If you don't, the strategy might not be for you. Do you have the tolerance for this strategy? So if you know that you've borrowed money and now you're investing that borrowed money, do you feel comfortable with that? If you do, then yes, the strategy might be for you. Another important factor, do you have access to a HELOC, a line of credit, or a mortgage where you're able to sort of reborrow against? Again, this is something Charles can help you with. If you don't have access to this, this might not be a great strategy for you, but if you do have access to this or you're not sure, again, this strategy might work for you. Okay, another big thing to consider before diving into this strategy is, do you have the experience or the knowledge to invest in the financial markets? Or do you know someone that does that can help you? So if you do not have the experience, the knowledge, nor do you have the time to learn, nor are you willing to hire somebody that can help you, this strategy might not be for you. Okay. But if you do have some knowledge, experience, or you enjoy learning about these things, or you do want to hire someone that's going to walk you through it, this could be a great strategy for you. Another thing is this strategy is only available if we borrow money and then we invest it in an investment portfolio in a non-registered account. Do not attempt to do this in your tax-free savings account, your registered retirement savings plan, an RESP, or a first-time home savers account, okay? If you do that, strategy is not going to quite work as planned, okay? You're not going to get that interest tax deductibility. And keep in mind that this strategy that Charles and I are talking about here tonight is we're borrowing money for the purpose of investment, whether it's real estate or a stock market portfolio. And it's meant to reduce your taxes too, right? It's turning that bad debt into good debt. It's creating that tax deductibility. Keeping in mind that the things that we're borrowing the money, we're investing it, the things that we are investing the money into might also generate taxes for us, right? If we make money, sometimes we have to pay taxes. So it's so important to make sure that if you're investing in a stock portfolio, that you're choosing the right investments to make sure that your tax savings are going to outweigh taxes that you generate as a result of investing. Charles, you can click on to the next slide. Okay, perfect. So yeah, we can just go through, Charles, you can just click through all of this if you don't mind. So that's great. One more click, that's great right there. So I'll just go over this for a second, but in our examples tonight, I'm going to walk through two scenarios that I think might be applicable to some of the folks on this call tonight, where I'm actually going to show you the benefit of investing money out of your real estate or HELOC or line of credit, whatever you have, borrowing money, turning around, investing it into different types of investment portfolios, and how you can use this to build your wealth. We're actually going to look at some of the numbers now, okay? So I'm going to take an example again. I think it could be applicable to some of the people on this call tonight. I've had to make some assumptions. You know, of course, as I'm going through these numbers, feel free to kind of in your head scale up or scale down depending on your situation. So at a basic level, imagine you have some real estate and you have $250,000 of equity in your real estate, maybe in your rental property or even a primary residence. And you are going to take out a HELOC against that equity, and you're going to do it maybe at about 6%. You're going to borrow that money against your property, and you are going to turn around and invest your $250,000 into a portfolio of some sort. Okay. When I talk about portfolios, I mean, this could mean something different for everybody. We could have a growth investor who's maybe interested in US stocks, international stocks. We could have someone that's a little bit more conservative, that's more interested in a Canadian dividend paying portfolio. Both of those are good options for this strategy. You're going to see here in a minute that one strategy might be a little bit better than another strategy. But again, it's really going to depend on your own risk tolerance and what you're trying to achieve with this. But I want to show you how different types of investments into the stock market can achieve a wealth building for you using these borrowed funds. So again, I'm an investor. I've borrowed $250,000. I've turned around and I've invested it in a non-registered account. Okay. As we know, when we borrow money for the purpose of investing into something that's going to make us more money, we can deduct our interest expense. So using this example, someone who's borrowed $250,000 at 6% has an annual interest cost of about $15,000 per year. This means that I'm able to deduct $15,000 off my income tax return. And so, deduct $15,000 off my income. So if I'm someone that's making, I don't know, over $150,000 a year, I'm at a marginal tax rate of 40%. I deduct $15,000 off my income. I'm going to save roughly about $6,000 in taxes. So I'm either maybe getting a refund of $6,000, or I'm just simply saving $6,000. I'm paying $6,000 less on my taxes. Charles, you can click through now. That's perfect. Thank you. So in this example, I've assumed that someone has borrowed $250,000 and they are investing in a growth portfolio. So what a growth portfolio might mean today is they have an overweight to US large cap equities, and they have some international equities as well. The investment that they've purchased is primarily going to be produce capital gains. In other words, we're buying stocks, ETFs, or mutual funds that aren't necessarily producing any dividends or distribution or interest. We're not buying bonds or high interest savings in this example. We're buying stock investments that are going to grow. You know, the idea is we're buying them at this price and they're going to grow to this price over time. Okay, so they're going to grow, you know, about 8%. So again, I borrowed $250,000. I've invested it into my stock portfolio and I'm earning 8% a year. Well, 8% on $250,000 is about $20,000. So I've just made $20,000 from my stock investment. Okay. Now I'm going to sell that part of my investment. I want to take my $20,000 home with me. Generally, when we make money, we have to pay taxes. And so in this example, my investor made $20,000. There's a 50% capital gains inclusion rate on that money. They're at a 40% tax bracket. So they're going to owe about $4,000 on their $20,000. Now, you might be saying, well, Jacqueline, you know, the capital gains inclusion rate just changed to 66%. Why are you using 50%? Keep in mind that here we've assumed an investor holding money personally, not in a corporation. They don't have a lot of other investments. And so this 50% inclusion rate is totally still applicable, makes sense for this investor right now. Okay. So I have borrowed money that I had to pay interest on. I invested my money, I made money. I had to pay taxes on my earnings growth, but then I also saved taxes on my tax return as a result of my interest tax deductibility. So, did I make any money here? Yes, you did. Looking at the blue screen at the bottom, you can see that I borrowed money. So, I had to pay $15,000 in interest expenses. I still had to pay that throughout the year. But hey, I made 20 grand on my investment. So, that's good. But then I had to pay $4,000 to CRA for the money on that profit I made. But then I saved $6,000 in taxes on my tax deductibility from my interest expense because it was borrowed money. So in this strategy, I would estimate that this investor is ahead by $7,000 as a result of using this strategy. Okay. They have had the opportunity to keep their real estate. They've borrowed against it. They had the opportunity to invest in the stock market. So this calculation here isn't even including maybe some of the appreciation that they've seen on the real estate in the meantime. What do they do with their $7,000? Well, they can take that $7,000 and they could apply it against maybe some non-tax deductible debt, like Charles showed earlier, turning again that bad debt into good debt. Maybe they want to spend it, or maybe they're going to turn around and reinvest that $7,000. Okay. And they're going to let that $7,000 now grow at another 8%. Charles, we can go to the next slide now and click through that. So, in that example I gave, the investor was, invested in a pretty heavy US equity, international equity stock portfolio, takes, a little bit more risky, right? What if you're an investor that, you're a little bit more conservative, you're a little bit hesitant to invest in US equities right now. We have the US election coming up. We're not too sure where things are going to go. You'd prefer to kind of keep to something a little bit more conservative, but still make some money in this strategy. So for that type of investor, I might recommend something like a Canadian dividend portfolio. So going back to our initial assumptions, this investor, instead of investing in US growth stocks, they're going to invest in something a little bit more conservative, like a Canadian dividend portfolio. We're probably going to see a lot of bank and energy stocks, things like that. In terms of the tax savings that they receive on their, as a result of doing this strategy, so borrowing money and then deducting that interest off their tax return, they're going to see an immediate $6,000 refund, just like they did in the previous example. They've borrowed the same amount of money, so nothing has changed. Charles, if we go to the next slide. We're going to see that things change a little bit. The net benefit is a little bit less, and this is simply because we've chosen a different type of investment. We know we've saved taxes on one end, but we've also made some money and we have to pay taxes. And this strategy is not quite as tax advantageous. And here's why. So again, I've borrowed $250,000. I've invested in it into a dividend paying portfolio, Canadian dividends being the key point here. And I'm earning an 8% yield on that $250,000 investment. So 8% dividend yield on $250,000. Again, hey, I've made 20 grand. That's great. The taxes owing, though, are about $6,900. And that's because, again, I've invested my money, I've made money. The taxes on dividend income that I make is not quite, it's a bit higher than what I would have paid on, like, let's say a growth portfolio, like my previous example. And that just has to do with different tax rates. I won't get into it. I have the calculations if anyone wants to see it. But again, I owe taxes on this dividend income that I made. So similar, if we look at the net benefit at the bottom, you can see that I've borrowed money. I've had to pay 15 grand out in interest expense through the year on that borrowed money. But hey, I made $20,000 in dividends. I had to pay $6,900 in taxes on those dividends, but then I got back $6,000 on my tax refund as a result of being able to deduct the interest expense on this borrowed money. So I'm ahead $4,100 here. Okay. I'm still ahead. Again, the benefit here is that before, if we weren't doing this strategy, So, and I hadn't borrowed any money, then I wouldn't have invested anything because I didn't have the money to do it. So I had to borrow the money. I invested it. I made money. I paid some taxes. I saved a bit of taxes. I'm still ahead. The alternative is that if I didn't do the strategy at all, I wouldn't have made any money. So I think we can see here two strategies. We have a growth portfolio, we have a dividend portfolio. One's more risky than the other. The more risky portfolio has the potential to have a bigger benefit, but that's generally how it goes with investing. The more risk, the potential for greater return. Charles, can we go to the next slide? So I've shown you, I mean, on paper, this looks great. I've had clients that have done it. It can work. So let's go over again some of the benefits of why we might want to do this, but also look at some of the risks involved so that you can really decide if this is a strategy that you think will make sense for you. So we can click on. Okay, so some of the benefits, and this is going to be, again, very similar to what Charles spoke about earlier, is that if we are borrowing money, specifically if we're borrowing money against our real estate, for the purpose of investment, we've now had the opportunity to totally diversify our portfolio. So we still have our real estate, we've borrowed against it, and it's allowed us to invest in the stock market with that borrowed money. So now, just say you're heavily invested in real estate, wishing that you could invest in the stock market. Well, this is a way you can do it now. You have, real estate and stock market investments. The tax advantages that Charles spoke about applies to this concept as well. So borrowing the money, putting it back into your real estate, or borrowing the money and purchasing stock market investments. Okay, you get the same tax advantages from doing that. I love this. Debt doesn't appreciate. That is so true. As long as you are borrowing the money and able to make your interest payments on that loan, the debt's not going to get any higher. And if we look back, if we borrow $250,000 today, in 10 years forward, we look back on it, that $250,000 10 years from now is not going to seem as big as it does today. So because the debt is not appreciating, if anything in our minds, it'll almost be like it's depreciating. However, financial assets like real estate and stock market investments do have the ability to grow and appreciate over time. In summary, this is a way that they say you can have your cake and eat it too. In other words, you can have your real estate property, but there's still an opportunity to invest in the stock market without having to come up with net new cash, but rather borrow against existing properties. Okay, and finally, next slide. So, with any great strategy, sometimes there can be risks, and I don't think that Charles and I would be doing our job if we didn't, go over what some of those risks could be. And then it's up to you to decide if this is something that still makes sense for you. Charles and I are here, of course, to help you walk you through these in more detail as it relates to your specific situation. A big risk, we've sort of seen this over the last couple of years, is interest rate risk. So if we borrow money for the purpose of investing, maybe we borrow initially, rates are at 1.72% like they were in 2021. And then 2022 happens and all of a sudden our borrowing rate shoots up to 6-7%. You've borrowed the money, the interest rates have gone up. Do you still have the ability to pay off that interest? And that's part of the due diligence that a non-brokerage account institution would do, or that Charles or I would do as well. Okay, it's just making sure that you can afford the interest payments if interest rates start to change. There could be some extra costs with this as well. It's not necessarily free. If we're doing a strategy, maybe we have more tax slips that we're having to produce, a little bit more record keeping. If we've hired an accountant, they might charge a few extra dollars for those extra tax slips. I'm not sure, but it could be a very minimal cost. There could be an appraisal required on a property if we're borrowing against it. It's going to take time to set up this strategy and to monitor, but once you get it set up, it's sort of running on its own. And of course, if we're borrowing money and investing, just like any investment, there's always the opportunity that the investment could either go up or down in value. And we just need to be aware of sort of what our risk tolerance is and purchase investments, whether it be a growth portfolio or a dividend portfolio that's going to match well with our risk tolerance. Okay, we can go to the next slide. But I think that this pretty much sums up the strategy. You have a good idea of, the risks, the benefits, but also how this can actually work and different types of portfolios that you could consider if you were looking at doing this strategy. So thanks for that. Charles, I'll hand it back over to you at this point.
Thanks, Jacqueline. Thank you so much. I had a quick question though for you. You mentioned that the investments would be would also people be able to just maybe put a monthly investment into the account as well?
Sorry, can you repeat that first part? I was talking about doing a lump sum payment.
You were talking about a lump sum payment for, like,
Yeah,
let's say they refinance and took a line of credit and they took a large amount out, like let's say
yeah,
250,000. Would
yeah.
they also be able to do, like, let's say a monthly contribution to the investment account and be using that to invest over time?
Absolutely. So whether you're doing a lump sum or you're doing smaller tranches monthly, this could totally be achievable. For the purpose of the presentation, it was, easy to show the lump sums, but as long as you have proper record keeping and you're knowing how much you're borrowing each month, to then invest, absolutely this could be done, through quarterly, monthly installments as opposed to lump sums. Absolutely.
Awesome. Thank you so
Mhm.
much for that. Thank you. All right. So guys, again, if you guys have any questions, please put them in the Q&A section, and we will take those questions at the ending of the presentation. So thank you, Jacqueline, for that. And I'm going to keep going with this presentation. So I have a couple of examples as well that I wanted to show you guys. And here's a scenario of somebody who owns an existing rental. So this is somebody, because everybody's going to be in different situations. So right now, this is somebody who owns their primary residence and also owns an existing rental. So I'm just showing you a quick example of what something would look like, right? So first thing we look at is how long it takes to move the full balance of the mortgage over to the investment line. A debt conversion. So that's right there on the top there. And usually it takes anywhere between 6 to 12 years, depending on how many properties you have. I've actually seen it lower than 6 years. I've seen it as low as less than 4 years. But in this case, it takes about 9 years to achieve that. This doesn't mean that the mortgage is paid off. It just means you've reached a point where the debt is completely tax deductible, and we are receiving our maximum annual tax refunds. The next thing we're going to look at is the total value of those refunds earned in the plan. This assumes that the rate of interest is constant and the marginal tax rate doesn't change either. In reality, these things can fluctuate, but it does give a sense of a total amount of the tax refunds and what we can expect to receive in this particular strategy. In this case, the homeowner receives $117,000 in refunds over the life of the mortgage. Technically, the homeowner can do whatever they want with those refunds. It's theirs. Whatever they want, they can do it with. But for this particular scenario, we're using the projections and we're assuming that the homeowner is going to use the refunds to pay off their mortgage faster. In this example, the net effect of using the tax refunds to accelerate the plan, right, it will be able to pay off the mortgage 97 months ahead of schedule, which saves $272,000 in future mortgage payments. Taking into account that it'll make our mortgage payments with after-tax earnings, we can calculate the level of income required to make those payments. At a 40% marginal tax rate, we would need to earn $453,000 to make those 97 payments. That's close to $500,000 of income that can go towards more important things and possibly help homeowners retire many years ahead of schedule. Technically, the homeowner is mortgage-free 97 payments sooner than otherwise would be. And in order to provide an apples to apples comparison, we assume that making those payments and reinvesting those 97 payments to the end of the original amortization so that they can earn a rate of return on their future savings. And this is what I was kind of talking about with Jacqueline. So let's say they paid off their mortgage 97 payments earlier, but when you guys purchased a home, you committed to making a payment for the next 30 years. So why not, after the mortgage is paid off, continue to make those monthly payments, but instead of making it to your mortgage, invest it. Invest it into a vehicle that Jacqueline was talking about so that you can be able to receive higher returns with those funds. So in this particular presentation, we're showing you a future value of 1.2 million. There's no liabilities. The investment line of credit and the rental mortgage are both paid in full. And finally, you see a net wealth of $348,000, which essentially is the future value of those 97. And we did this at a growth rate of 6%. It's worth noting that our calendar allows us to include or exclude the rental property depending on the circumstances. In this particular scenario, the homeowner already owned the rental property and would have benefited from the value of appreciation with or without this strategy, which is why we excluded the rental value in the net worth improvement in this particular circumstance. So let's take a look at this particular scenario. This is one where the person is actually buying a new rental property. So you have your primary residence, you decide to do a refinance, pull some money out, and then purchase an investment property. So for this one, they pulled out $125,000 from the line of credit, to use for the down payment, right? The property is cash flow neutral, meaning the rental income is sufficient to offset the expenses for the carrying of the property. The debt conversion is going to happen a little faster. It's going to be 8.4 years. The reason is, it's because we borrowed the down payment as well, which results in initial higher tax refunds, which we then take those higher refunds to pay down the mortgage faster, which we get a conversion process that's going to exhilarate. Over the life of the plan, we see $259,000 in tax refunds. Again, because we're borrowing more and it takes longer to retire the debt, we find the longer time on the horizon for earning refunds. Keep in mind, we're not adding any additional funds to service the borrowed down payment. The structure is covering the payments for us, which is why we see a reduction in payment savings from the previous scenario. Overall, we're still ahead of the original amortization, which is reduced by 8 payments by totaling $22,000. Factoring for the tax, that income savings is about $37,000. Using the growth rate assumptions, and we're going to keep it the same on all of these scenarios, here's the future value of payments. And the scenario, which is including the value of the rental, because we acquired the property as a part of this strategy, which gives us $1.2 million in additional wealth creation for the homeowner. The investment line of credit, the rental mortgage, and the primary residence are all paid off, leading to a net worth improvement of $1,244,000. Again, it's worth noting, they were able to acquire the property, self-fund the down payment, plus cover all rental expenses without any additional cash inputs beyond the regular monthly mortgage payment on their home. All right, now we're going to look at that same rental, but let's say it cash flows negative. So we're now seeing a debt conversion of 9.17 years. There's a total tax refund of $426,000. Remember, we're keeping all the gross assumptions the same. The future rental value, there's no change. It's still 1.2 million. The outstanding liability, this is where we begin to see a difference. The investment line of credit has a balance remaining of $343,000. That's because we ran a negative cash flow for 15 years. We drew on the investment line of credit to cover the shortfall along the way. Now, let's take a look at the net wealth improvement. Remember, we're comparing the timelines against the original amortization on the primary resident mortgage, which is 30 years. At that point, in this time, we see the rental property is worth $1.2 million. We subtract the balance remaining from the investment line of credit of $343,000, which gives us $877,000 after paying off the balance. So for the people who find themselves in a cash flow negative standpoint, this actually works really good. So you can actually put the rental income through your primary residence and allow your line of credit to carry it for you. So you don't actually have to carry it yourself. This is actually using the debt to your advantage. What is impressive about this is that we're able to purchase a property where the expenses are higher than the income and still have it make financial sense. The structure covers the shortfall through the investment line of credit, which allows us to own the property without having to make any concessions elsewhere in our lives. Earlier in the presentation, we talked about having to choose between our lifestyle today and investing for tomorrow. With the rental cash stemming strategy, it is possible to do both. Again, thanks to the tax efficiency of the plan, combined with the ability to leverage the structure to service the cash flow obligations of owning the rental property, the homeowner is able to make serious headway on their wealth improvements without affecting their personal cash flow on their lifestyle. Which means if you understand and apply this financial technique correctly, you may no longer have to choose between saving for the future or enjoying your lifestyle today. So here's where I ask you guys where we're going to create a game plan. So I ask you guys to scan the QR code and book a call with me. So what we're going to do in that particular game plan is we're going to go through your scenario. Everybody's scenario is different, right? Some people are here and they have one property, they're looking to purchase a rental property. There's some people here with a property and a rental property, and there's some people here with a property and multiple rental properties. We also got some people here who may not have any properties. So we all have different situations. So I ask for you guys to book a call. The call will take anywhere between 10 to 15 minutes. I will ask you a series of questions, right? We will go through your goals and affairs. Then I will tell you your conversion date. What is that conversion date? That means when you have converted your non-tax deductible debt into a tax deductible debt. And then I will tell you what your max tax refunds are. And then how long it will take for you to get your net wealth improvement. So that's two things to show you how long it will take for you to be mortgage free and also build your net wealth improvement. And from there is where I would introduce you to Jacqueline, and she would talk about some of the investments that you can go into to build that net wealth improvement. With my calculator, I would show you assumptions based off of the percentages, but Jacqueline will actually put you into those investment vehicles so that you're able to grow your net wealth improvement after you have become mortgage free. After that, we will go through any questions that you may have. Thank you guys so much. So please take a second, right? Scan the QR code and book a time so we can discuss. Thank you so much, Jacqueline. Thank you for being in this presentation and sharing a lot of your knowledge today with everybody tonight.
Thank you, Charles. And thanks for having me. It was, I love listening to you talk and giving these sessions. So, learning lots myself from you on the strategy when it comes to real estate.
It's great. I do have, since you're here, right?
Yeah.
I do have questions. I'm
Yeah.
also hoping that people have put some questions in the Q&A so we can
Hmm.
discuss, because there was a lot of good information that we discussed today, and I'm hoping that people took in this information and are able to use it, right?
Hmm.
So before I ask my question, there's a question here in the Q&A. What are some good readvanceable mortgage products out there in the market? Okay, so I'll take that one. So the readvanceable mortgage product, it's basically a mortgage and a line of credit. So what you're doing is every time you make your mortgage payment, your line of credit grows. That's really what the readvanceable is. So the idea with the cash damming strategy is to make a prepayment, which allows you to be able, because that prepayment is all principal, which grows the amount for that entire amount. So you're able to pull it out of the line of credit and now use it towards your investment property. And that's what you're trying to do. And what you're trying to do is move your non-tax deductible debt over to being tax deductible. So I'm just gonna wait to see if anybody else has questions. But in the meantime, when they do, I have a couple of questions for you, Jacqueline.
Okay.
The
Let's hear them.
non-registered brokerage account that you're talking about, is there a cost to that?
Good question. And so generally it's going to depend where you set it up. I know a lot of banks, you can just kind of open it up probably, through an app. TD, RBC, BMO, I think have those. You could use a robo advisor. So we all know a few robo advisors. They might have a cost associated with setting it up. Again, it's probably going to be a very minimal cost to actually set up the account. Myself, where I am at Assante Capital Management, we have a cost structure for our accounts that's going to be a little bit different per investor. Generally, you're going to be incurring some minimal cost to open up an investment account, whether it's you're trading stocks or ETFs, or there's an annual client cost. There's going to be some sort of minimal cost to open up the account. Yeah.
Guessing when working with somebody like yourself, they also get you and your 10 years experience in
Hmm.
investing as well with that,
Hmm.
right? So by far, even if there is a minimal cost to opening it up, there's a plethora of knowledge that they're getting by setting it up with you. Am I correct?
Yeah, that's correct. And thank you. So, I work with a lot of busy working professionals or landlords, people who are sort of busy doing the things that they're good at. They know they want to invest, but they don't necessarily have the time or the care to really learn all the strategies behind it. And so they'd work with someone like myself and my team who's going to take, a look at their whole situation, determine what it is they want to achieve. We're going to help them get there. We're going to provide the strategies in terms of, okay, if you're borrowing money to invest, what type of account, should you be doing that in, and what are the best investment vehicles to do that with, whether it's, again, growth portfolio, dividend portfolio, or something else. So we're going to help figure that out for them, as well as the tax implications, the tax savings. Um, Probably they might have some other investment accounts like TFSAs, RSPs. We can help them with investing that as well, making sure that they're invested in the right things at the right times, and going through cash flow analysis too with their investments. So if they do have real estate and they want to know how that plays into their overall retirement plan, we can show them how that will provide for them in their retirement years, in addition to their investments that they have. So
Awesome,
yeah,
awesome,
it's not just about picking the stocks. That's important, but there's a few other things that go into it as well.
awesome, awesome.
Yeah.
Um, so I wanted to also throw out this question. I'm going to throw out this question for myself, which is
Okay.
a very popular question that a lot of people ask when it comes to the cash flow strategy is, okay, so who's actually paying the line of credit? So once you've actually prepaid the line of credit and it's now growing, who's actually paying it? Well, think about it from this standpoint. When you're making your mortgage payment every month, right? Your principal and interest, your mortgage payment stays the same. So there's a little piece of your of the principal there that always grows on every payment. So when you're now doing the prepayment with the rental, sorry, not the rental, with the prepayment of the rental income, right? What you've done is you've actually pushed the principal out more. So there's more of the amount there. So that amount is actually what is used to pay the actual line of credit. So it actually doesn't come out of pocket. So when you do that now, after the year is up, you would take your statement, your line of credit statement, and you would give it to your tax accountant. And that's where he would take it into your taxes and you start to receive the tax refunds. That's usually a very popular and a frequently asked question when it comes to this particular strategy.
Okay. And Charles,
So
I know we talked a lot about, using this strategy and people with multiple investment properties, but you would help, someone even just looking to take on a first mortgage and wanting to know what options are available to them. Like you work with first-time home buyers as well, who
that's
maybe
correct. I
aren't ready
do.
for this strategy, but just sort of getting their foot in the door.
Yeah, I do. I
Okay.
do. I find that first time home buyers is, you know, it's a tough first step to be able to get into the real estate world and understanding. So there's a lot of hand holding, a lot of questions that are being asked, just so they can understand. It's a nervous step, but yeah, I do help them in getting that first step into the industry, into buying their first home.
Okay. And you would have the
So
ability to work with not just bank, but other lending institutions, I guess,
that's
for setting these
correct.
up. Okay.
Yes, thank you for that. I work with a series of different lenders. It's not just banks. I have access to actually over about 50 different lenders. As you know, there's only about what six major banks, so there's so many other lenders that focus on helping clients to be able to get a mortgage, whether it's on the A side or the B side or even on the C side. So that is something that I'm able to help out with that.
Yeah, it's like a lot more options than just walking into your bank and taking what they give you.
That's correct. That's correct.
Yeah.
We're keeping with that. RSPs.
Hmm.
I know they recently upped it from 25,000 to 35,000.
Hmm.
Are you also able to help clients be able to get, like, say, RSP loans to use
Um,
towards the
yes,
first time
and
home buyer?
yeah, exactly. And so if you have, and I think the limit might have just gone up, but if you have a RSP and you're considered a first-time home buyer, now there's some rules around what dictates if you're a first-time home buyer. Generally, you can't have owned a property in the last 4 calendar years. But yeah, we help facilitate the first-time home buyers loans against the RSP, which is a way that you can take money out of your RSP tax-free. Normally, if you're taking money out of your RSP, you're paying taxes on it. There's a few exceptions for taking money out. Normally you take money out of your RSP, you pay taxes. If you're taking it out for the purpose of buying a first-time home, it's not taxable. Now you will have to pay it back over a series of years. You do have to pay the money back. Last year, the government came out with the first-time home savers account. So that's another option as well for anyone looking to save for a first-time home. That's a great account. It really kind of combines the benefits of an RRSP and tax-free savings account. And it's just a way for people to save a little bit more for buying that first home. And when I'm talking with people that are saving for a home, we'll go through the RSP versus the first-time home savers account to see which might be a better fit for them. Yeah.
Based off of that, let's say
Mhm.
it's husband and wife. Are they able to combine their amounts together?
Yes, good question. So, when taking money out of an RRSP for the purpose of buying a first-time home, if you and your partner both have RSPs, you can each take from your own respective RSP. So
It's awesome.
essentially doubling how much you can take out tax-free.
I know with housing prices where they are, it's probably something that is necessary to do today.
Exactly. Exactly. And so the home buyers plan, it looks like they just increased it to 60,000 actually. So theoretically, if you and your partner each have at least $60,000 in your RSP, you could take out 120,000 collectively.
Know that just happened?
Yeah, I know that that was a change that was recently made. I'm fairly certain we can confirm that after. But I think that did just change recently. So I'll confirm that though, because I am getting conflicting information, but I know that the government had made some changes to that program recently. So
Yeah,
I'll confirm that.
that'd be a serious game changer for
And then
people.
in
Wow,
addition to the first time home savers account, I mean, someone could be taking out quite a bit, um, tax free. Yeah. Yeah.
that's awesome.
hmm
Okay.
So lots of options.
Jacqueline, thank you again. I know we went over the 45-minute mark that I mentioned in the beginning, so I don't want to take up any more of your time, but thank you so much for tonight and spending your time with us. And please, everybody, here is my QR code again. Please book a time with me. Will roughly be 10 to 15 minutes. We can discuss your scenario, discuss your game plan, and figure out if this thing makes sense for you. And then from there, we can actually see where you can go. Thank you guys for tonight. Thank you, Jacqueline. And everybody have
Thank
a good
you.
evening. All right.
Thanks,
Awesome.
Charles.
Good night.